The problem with gold producers that just get the work done day in and day out is that no one talks about them. Those that are aware of their existence just sit back and watch as they do their thing and deliver on their commitments. Such is the case for Eldorado Gold, who this week announced that they have potentially extended the mine life of their biggest producing asset by an outstanding 17 years. Yet the market barely recognized the significance. So goes the mining sector. Let's dive in. Okay, let's start at the top. The life of mine extension for Eldorado Gold relates to the Lamaque complex, which is Eldorado's largest operation. For reference, the complex last year was responsible for 196,000 ounces of gold production, which is about 38% of the 520,000 ounces of gold produced by Eldorado last year. While full financial results aren't yet out for all of 2024, production costs for the 9 months ended September 30th came in at an AISC of about $1,228 an ounce, which is lower than the company-wide average of $1,310 an ounce. Okay, so this mine life extension consists of two parts. First is the reserve case, which basically outlines how many years of operation the company expects to get out of its operation just based on the gold that is in the ground where they are currently mining. Second is a preliminary economic assessment, which envisions an extended life of mine plan, which is largely based on resources currently in the inferred category at the Triangle and Ormaque mines, which are both part of the complex. Both scenarios come with an accompanying net present value, which on a combined basis comes in at $1.2 billion on an after-tax basis using a conservative gold price of $2,000 an ounce and a 5% discount rate. At $2,600 an ounce gold, which is still about $150 an ounce below current gold prices, that figure jumps to $2.1 billion. Let's begin with the reserve case. The reserve case currently outlines 8 years of life left within the Lamaque complex. This is based on an updated life of mine plan, which extends the prior estimate of 5 years to 8, with Eldorado expecting total gold production of 1.2 million ounces through to 2032. Much of the production is expected to be front-loaded, with average annual production through to 2028 estimated at 175,000 ounces, which is notably about 20,000 below 2024's production level, but still maintains the mine as being a sizable operation. Production over this 8-year period is expected to come in at $1,176 an ounce on an all-in sustaining cost basis, which is lower than current costing levels, so it's a bit questionable if it's realistic. Regardless, the economics here suggest the current operation has an after-tax net present value of $550 million based on $2,000 an ounce gold using a 5% discount rate. That's about all the data that Eldorado provided on the reserve case, but there isn't much complexity to it. Current reserves at the complex amounted to 658,000 ounces at the Triangle and Parallel mines, while another 619,000 ounces are estimated to exist at Ormaque. In other words, it's basic arithmetic that at X ounces per year, there is Y years remaining of production here. And then there's the PEA. Whereas the reserve case was focused on what is known to be in the ground, at least as best as models can suggest, the PEA is based on what is perceived to be in the ground. In this case, largely the inferred mineral resources that exist at the Triangle and Ormaque mines. The PEA currently outlines 9 years of mine life based on this inferred resource, with the operation expected to produce an incremental 1.5 million ounces of gold. The intent here is not for the PEA to be concurrent with the reserve case scenario, but rather sequential, thereby extending the Lamaque complex life of mine by a total of 17 years between the two scenarios, with operations to go until 2041. With that being said, there is some impact to annual production, with the PEA outlining that average annual gold production would average 185,000 ounces a year through to 2036, versus the lower 175,000 ounces a year through to 2028 that the reserve case alone would provide. Basically, the model outlines that the PEA case would bump up production marginally in 2028 before contributing a notable amount of production in 2029 to get that average annual production figure up higher. This increased production also comes at a lower overall cost, because more ounces means there's more gold to spread fixed costs across, with all-in sustaining costs under the PEA expected to come in at $1,149 an ounce. The assessment outlines an after-tax net present value of $623 million and an IRR of 43.5% based on $2,000 an ounce gold. At $2,600 gold, the NPV jumps to $1.1 billion, with the IRR coming in at 68%, which quite plainly is a ridiculously high rate of return as far as mining projects go. All right, so let's wrap it up. The extension of the mine life of Lamaque is a massive positive for Eldorado. As the firm's largest asset, extending the life of mine from what was previously 5 years to now basically 17 years, assuming all goes right, it gives a huge boost to the long-term outlook of Eldorado. And it should also be stated here that further exploration is ongoing, which provides the possibility for further discovery. For 2025, resource conversion drilling is planned at multiple deposits, while additional inferred resources are also being tested as potential lateral extensions of Ormaque. Exploration drilling is also planned both from surface and underground to test earlier stage targets. All this is to say that more potential still exists at Lamaque, providing the potential for the complex to remain in operation well past 2041. All right, everybody, thanks for watching. If there's any other stories you want us to cover, please let us know in the comments section. Also, if you enjoyed this video, please give us a like. Thanks for watching, everybody.